$94 billion. That is the current total allocated to crypto by institutional investors, pension funds, endowments, sovereign wealth funds, and publicly traded companies. Not retail speculators. Institutions. If your investment committee hasn't produced a formal position paper on digital assets by now, that gap is no longer acceptable. This is not a video about price targets or trading signals. This is a rigorous breakdown of what crypto actually is, how it works, and what a rational institutional framework looks like. Traditional finance deals in shares of companies, bonds from governments, and claims on real assets. Bitcoin is none of these. It is a protocol, a set of rules enforced by mathematics and distributed consensus. When you own Bitcoin, you hold a cryptographic key that grants spending rights on the network. No custodian can freeze it. No central authority can inflate it away. Understanding this distinction is foundational before any allocation decision can be made responsibly. A blockchain is a chronological chain of data blocks, each one cryptographically linked to the previous. Every node on the network maintains a complete, identical copy. To alter a historical transaction, an attacker would need to redo the computational work for every subsequent block while outpacing the combined computing power of the entire network simultaneously. In practice, this makes confirmed Bitcoin transactions functionally irreversible, a settlement property that no traditional financial system, including SWIFT or Fedwire, can match. The settlement mechanics distinguish Bitcoin from every prior payment system. There is no central clearinghouse, no settlement window, no counterparty risk in the traditional sense. When a transaction reaches 6 confirmations, it becomes computationally infeasible to reverse. For institutional treasurers accustomed to T+2 equity settlement or same-day Fedwire, the idea of a natively final settlement layer operating without a trusted intermediary represents a genuinely new architecture, one worth understanding at the infrastructure level. Scarcity is easy to claim and hard to enforce, unless it is written into the protocol itself. Bitcoin's 21 million hard cap is not a policy decision subject to committee vote or legislative override. Approximately 19.7 million Bitcoin have already been mined. The remaining supply will be released on a predetermined schedule through the year 2140, with each halving event cutting the issuance rate in half every 4 years. In a world where every major central bank has expanded its balance sheet significantly since 2008, this fixed supply architecture carries real institutional relevance. 15 years is a short time for an asset class to achieve institutional legitimacy. Bitcoin moved from a cryptography mailing list in 2008 to CME-listed futures in 2017 to a BlackRock spot ETF in 2024. Each of these milestones required a different type of institutional engagement, first derivatives traders, then corporate treasurers, then sovereign governments, and finally registered investment advisors with retail clients. The 2024 spot ETF approval was the inflection point that removed the last major regulatory barrier for U.S. institutional allocation. The 2023 price structure is instructive for institutional risk managers. Bitcoin entered the year at approximately $16,500, the aftermath of the FTX collapse in late 2022. It closed December above $44,000, a gain of over 160%. The volatility profile remains extreme by traditional asset standards. Peak-to-trough drawdowns of 30 to 80% are part of the historical record. Any institutional allocation framework must account for this volatility explicitly, not dismiss it, and not be deterred by it without understanding the return-adjusted context. $10,000 invested in Bitcoin at the start of 2019 would have grown to approximately $96,000 by late 2024, a 960% cumulative return. The same amount in the S&P 500 would have reached roughly $21,000. This is not an argument to overweight crypto. It is an argument to understand the magnitude of the return differential and to model what a 1 or 2% Bitcoin allocation would have done to a traditional 60-40 portfolio Sharpe ratio over that same period. Ethereum extends the blockchain concept from simple value transfer to programmable financial logic. A smart contract is code that executes automatically when conditions are met. No trust in a counterparty required. This infrastructure underpins an entirely new class of financial applications: decentralized exchanges, on-chain lending protocols, stablecoin issuance, and the tokenization of real-world assets including U.S. Treasury bonds. BlackRock's tokenized money market fund, BIDL, runs on Ethereum. When institutions discuss blockchain, they are increasingly discussing Ethereum-compatible infrastructure. Decentralized finance, DeFi, is an ecosystem of financial protocols that operate without central intermediaries. Stablecoins provide the unit of account. Lending protocols allow collateralized borrowing and supply-side yield. Decentralized exchanges enable asset swaps without order books or custodians. Yield aggregators optimize across protocols automatically. The entire stack is transparent, auditable in real time, and settles on-chain 24 hours a day. Total value locked in DeFi peaked above $180 billion in 2021. Today, it operates a mature, if volatile financial infrastructure that traditional firms are beginning to engage. Institutional crypto risk falls into three distinct buckets, each requiring separate management frameworks. Market risk is dominated by price volatility. Bitcoin's realized volatility runs 3 to 5 times that of equities. Operational risk centers on custody. The irreversibility of on-chain transactions means that a key management failure is permanent, not recoverable through insurance or legal process. Regulatory risk remains the most uncertain dimension, with SEC enforcement posture, tax treatment, and international frameworks still evolving. A serious due diligence process addresses all three buckets before any allocation decision. The most common institutional frame for Bitcoin is as a potential successor to gold in the store of value role. The comparison has legitimate structural merit. Both assets have supply constraints not subject to central bank discretion. Both have historically low correlation to equity returns during non-crisis periods. Bitcoin's advantages are portability, divisibility, and verifiability, properties that matter in a world of cross-border capital flows. Gold's advantage is a 5,000-year track record and a liquid, regulated market. The question is not which one wins. The question is whether a portfolio should hold some of both. Governance clarity before first allocation is the standard that separates institutional behavior from speculative behavior. Investment committees must define what maximum drawdown triggers a position review, who has custody authority and under what multi-signature framework, how gains and losses are reported to LPs or beneficiaries, and what regulatory changes would trigger a full exit. These are not hypothetical edge cases. FTX's collapse in 2022 eliminated an estimated $8 billion in institutional capital that had inadequate custody controls. The risks are manageable. Unacknowledged risks are the dangerous ones. The institutional relationship with crypto is no longer a fringe debate. BlackRock manages a spot Bitcoin ETF. Fidelity offers crypto custody. Franklin Templeton has tokenized money market funds on a public blockchain. State Street is building digital asset infrastructure. These are not early adopters. They are the infrastructure of American institutional finance. The 5 principles on screen represent the minimum framework any serious investment committee should have documented. Not a mandate to allocate, a framework to decide, with rigor, whether and how to engage. That is the institutional framework for crypto: first principles, infrastructure mechanics, risk taxonomy, and governance requirements. Every week on Crypto Mechanics, we go deeper into the specific mechanisms that drive this asset class. If rigorous, no-hype crypto analysis belongs in your research stack, subscribe and turn on notifications. The next video covers the economics of Bitcoin mining and what proof of work means for long-term network security.